Good morning, everyone. We'll just give it a couple of minutes while we wait for everyone to join. Just while we wait, down the bottom there is a Q&A button if you're joining on Zoom. So you can just click on that and it'll bring up the question box. Just feel free to put in any questions as we go. I'll try and answer them in the actual relevant section if it's not going to be answered already. And so you can basically open that up now and start firing through questions. And thanks to people who had sent through questions earlier. We'll try and answer those, or we'll make sure we answer those earlier questions as we go through as well. We'll just give it until 5 past, so another 2 or 3 minutes. We've still got people joining, so we'll just give it another minute or so. And just to repeat for people that are just joining now, if you're joining on Zoom, there's a Q&A button right down the bottom of the screen. You can click that; it'll bring up the Q&A box, and you can type in questions as we go. We'll try and answer them, or I'll try and answer them during the relevant section of the presentation. All right, I think we'll make a start. So, good morning, everyone. For those of you that are joining for the first time, great to have you. Hopefully this will put to bed a lot of questions that you have. For those of you that might be joining, who joined one of the previous ones, there's no real updates since the last webinar from last month. The only thing we'll be doing differently this time is covering a bit of stuff around offshore zones. So, just putting that out, making that clear up front. So in case you're, joining for an update, there's nothing really new. There hasn't been any really substantial legislation updates since the last webinar. That's just for those of you that joined the last one. For those of you that are joining for the first time, I can already see some of the questions coming through, which will be addressed by all addressed within the presentation. So we will get started. Okay, I will just share my screen. All right. So look, the presentation that we're doing, well, what we're going to walk through today is very much focused on small and medium businesses and micro businesses as well. What we are really looking at is, really almost a walkthrough of a workshop. So, what are the basic requirements? How do you satisfy those? And, try and work out whether or not your business will be needing to pay tax or not. Hopefully not. If it is, needing to pay tax, then what are some things you can look at to try and minimize that tax bill? So look, just a bit of context for where we are right now. For those of you that have been following, excuse me, for those of you that have been following sort of the rollout of the laws, there has been there's been a little bit of back and forth and a few delays. Now, that's quite understandable because in the UAE, the free zone system, or the scope of the free zone system that we have here in the UAE is unique in the world. And so the ministry has had a very tough job basically writing these rules from scratch, whereas you think of all the rest of the tax laws or the rest of the tax rules that they're having to do, they've basically had, hundreds of years of precedent from other countries to inform that. So it's really the difficulty is really around the free zones. But in saying that, I think we are now landed on where we will sort of stay for the free zone rules. And what that looks like for small businesses, not just the free zone rules, but the tax regime in total, is it's a very friendly tax regime for the startup, micro and small business sector. There are some very lenient rules, some nice relief rules, and of course, on top of all of that, you do have the free zone exemptions, although those are a little bit limited to compared to what was sort of originally slated. Okay, excuse me. I'm just going to go through some myths which we'll cover during the workshop. So some of the common myths that we have, and I just want to put these to bed straight away. A lot of people, or we have a lot of clients coming to me saying, I thought that free zones were exempt. My free zone told me I was tax free for 99 years. Now, unfortunately, that's not the case. So free zone companies are not exempt by default. You have to jump through some pretty complex hoops to get there, which we'll go through today. More specifically, there's this false understanding that companies that only do business outside the UAE, there's this impression or this myth that they will be exempt from corporate tax. Now, that's not the case at all. In fact, if you are a free zone company and you only do business outside the UAE, it's actually more likely that you will have to, that you will be a taxable business. One of the other myths that's going around is that if you are under the taxable threshold or under the small business relief threshold, that you can just sit back and do nothing, which is not the case at all. So there is a lot of confusion around paying tax versus being compliant. Now, every company needs to be compliant, even if they don't have to pay tax. So we'll get into the detail on this, but basically, even if you don't have to pay tax, you need to prove that you don't pay, that you don't have to pay tax, and there are steps you have to go through to make sure that you don't get fined. We'll start by going through some of the basics around the financial year and the reporting years. And then we'll go through the exemptions and the reliefs and, basically the layers that a company needs to fall through before they actually end up paying any tax. We'll also go through some of the sort of more technical on technical aspects in terms of compliance and, in terms of tax deductible expenses. And sorry, just a reminder again, the Q&A box down the bottom, or the Q&A button down the bottom, if you press that, it'll bring up a box to put in questions. You can use that to fire through questions as we go. Okay. I'm just going to jump ahead for a second because So first thing I want to talk about is the timing. So we're looking here at the compliance steps. So you'll get sick of me saying this by the end of this presentation, but every business, so every company needs to register for corporate tax. They need to keep proper accounts, so they need to produce a profit and loss and a balance sheet. And they will also need to file a tax return. Now, this doesn't matter whether you're in a free zone or, if you're under the threshold or, you don't earn any revenue, you still have to go through those 3 steps because you have to prove your tax position to the FTA, whether or not you're paying tax. So the first question that comes up a lot is around the financial year. So that's whilst for some companies that seems like a bit of a no-brainer, I'd say probably the majority of companies in the UAE, a lot of them have never had to do any kind of financial reporting any accounting before. Even if a company has had to file VAT returns, that doesn't actually reflect your financial year, so your financial reporting year. So look, there are a couple of pretty simple rules to work this out. Okay, so 99% of companies in the UAE will follow a financial year that goes from January to December. Okay, if you are in 99% of the free zones or the mainland, then your default financial year is January to December. Okay, and what that means is that tax for you starts on the 1st of January 2024. So in about 3 weeks is when everything kicks in. There are a few exceptions to this. Okay, so one exception is if you have ever changed your financial year by director's resolution, for example. So, the free zone says that your financial year runs January to December. Well, if you've filed a resolution with the free zone that says, actually, we're going to change it to, May to April, that means that your financial year is a little bit different. Another exception to the financial year is if you have just started your company, right? If you've just started your company and you open your company after the 1st of June 2023, that means that your first financial year is a long year because you need to align to January, December going forward. So easy thing to remember, if you started your company after the 1st of June 2023, that means that you are taxable straight away. So you opened your company into a live tax environment. Okay. The third exception to the January-December rule is if your company is registered in Dubai World Trade Center, so DWTC. If you are registered in DWTC, that means that your financial year follows a different pattern. What DWTC does is if you opened your company in, let's say, August, that means that your financial years run August to July every year going forward. So it never aligns back to January, December. But that's pretty much only DWTC. Every other company, every other free zone, they align your company to January, December. There is a question here which says from Neil, so if your accounting year starts in April, does your corporate tax obligation then start as well? So that's correct. So if your accounting year has been, you just need to check, because if there's an accounting year versus your financial year by the free zone, but if you currently do financial reports already that go April to March, that means that your financial year runs April to March, and that means that you will only be taxable from the 1st of April 2024. Okay, so you've got an extra couple of months. But that is, just to reiterate, that is only an exception for basically, the example I was talking about where companies have a different financial year. If you've never touched your financial year or you've never produced accounting reports before, then you will be aligned to the default, which is January to December, which means that tax for you kicks in on the 1st of January 2024. It means you don't need to file a tax return for 2023, so this year is effectively still tax-free. But by the 1st of January 2024 is when you need to be underway with all of your compliance steps, notably your accounting. So the accounting is pretty much is the main sort of immediate need to get up to speed on. Again, this is regardless of whether you're in a free zone or or you're under the threshold. You still need to do accounting to prove it. So that accounting needs to be up and running by the 1st of January. Okay, fire through questions on that as we go. If you have any questions around the administrative side. Okay, I've got a question here around Virtuzone's accounting services. Do we adjust them based on your company's activity side? Absolutely. So at Virtuzone, we're doing a free package at the moment, so you can sign up at taxready.ae. We do your corporate tax registration for free. We get your books up to speed, so we give you 3 months, October, November, December 2023 accounting for free, so that everything's up and ready to go from the 1st of January. And Asma, your question, yes, we charge a fee based on the size. So from January onwards, in the tax year, we charge a fee, but it's based on the size of your company. So if you have 0 turnover, then it's obviously very, very, very cheap. If you have less than 10 transactions a month, then it's still very cheap, and then it sort of goes up based on the number of transactions going through the business per month. Okay. Neil, you had another question around accounting. We'll get to that in a few slides. There's a question here around freelancers and e-traders. So I'll just answer those before we start. So there was a somewhat recent law that was announced. So what they have said is that, what the ministry have said is that if you're operating the business as a natural person as opposed to having a company, then there are slightly different rules that apply. So the way to think of this is, all right, is there a separate legal entity, right, which is a company? If yes, then you have to register. You have to go through all of the corporate tax process, so you're in scope. If you are operating a business activity as yourself, which basically means you're a freelancer or you have one of those e-trader permits, right? So there's no separate company, there's no legal entity. It's just you basically conducting a business as yourself. That means that you only have to register and go through the compliance steps if your revenue goes over 1 million dirhams. So to summarize, if you're a freelancer, you only need to register if your revenue goes over 1 million dirhams, and that's just your business activity revenue. If it is e-trader or sole establishment, so it's under your own name, same thing applies. So you only have to register. You're only in scope for corporate tax if your revenue goes over 1 million dirhams. For everyone else, so every LLC, free zone company, everyone. And Oriana, you've just asked a question. An LLC with a single owner, that is a limited liability company. So that's a separate legal entity. That's a company. So you're in scope immediately. That 1 million dirham threshold doesn't apply. So basically every company, every limited liability company, every free zone company, you have to register regardless of what your revenue is. It's only the freelancers and the e-traded permits that can, that only have to register after 1 million dirhams. So think of it this way, right? If you are selling, an old table on Dubizzle, you're not going to have to register for corporate tax, right? But if you're selling 1 million dirhams worth of tables on Dubizzle, then that's starting to look very much like a business activity. So that's when you get treated like a business. So just to clarify again, that was what we were just talking about there. That 1 million dirhams only applies for freelancers and e-traders, basically where there's no separate legal entity. They're doing it under their own name. Okay, back to the majority, which is companies. So every company, as we just mentioned before, has to register for corporate tax, has to keep proper set of accounts and will have to file a tax return. Not necessarily pay tax though. So what we'll go through now is sort of the 4 layers that a company needs to fall through before they actually pay any tax. So the first layer, we'll look at this from a free zone company perspective, because a free zone company has 4 layers, a mainland company just has 2. So a free zone company can be exempt under a couple of methodologies. So one methodology looks at the geography of your clients. So if you're a free zone company and your clients are all free zone businesses, right? So you are just existing within the free zone bubble. That means that the free zone exemption will be available to you. You have to do some other steps as well, but the most difficult part, which is the qualifying income test, you satisfy that if your revenue is all coming from other free zone businesses. It doesn't have to be within the same free zone. It can be free zone to free zone, but it all has to be within that free zone layer, that free zone bubble. Okay. Now, I know that, and that's sort of the strict rules of the free zone, but I know that it's a bit of a gray area. Most companies don't stick just to within the free zone. And I know many free zone companies sell to companies overseas and also sell to mainland, which would mean that, which would basically mean that you don't qualify for that exemption. So if 100%, if you're only selling to an offshore company, right? That company is not in a UAE free zone, so therefore you don't meet this criteria. The second criteria to look at, right? So let's say you don't meet that first one, so you're selling outside the free zones. Second criteria goes, okay, well, let's look at what are your activities. So the ministry has released a list of what's called qualifying activities. And the rules basically say that if you are deriving your income from these activities, then you will meet the qualifying income criteria. Okay. I will just jump to that list for a second. Now, as you can see, it's a pretty detailed list, but it's not very wide in terms of scope. So there are very specific industries that a free zone company can operate in and get this exemption. All right. They are mainly around either heavy industry or insurance and wealth management and fund management. There are a couple of activities which may be available to smaller companies, right? But in generally speaking, services are not included in the activities. So things like there are lots of management consultancies, marketing consultancies, online trading, or online services, sorry. They don't qualify for this free zone exemption, right? So we have lots of clients who, for example, they have a company in a free zone. It's just them. It's just one person. They're providing management consultancy services to a company in the UK, for example. They won't meet this criteria for the for the free zone exemption because their client is not in a free zone and they're not doing a qualifying activity. So what we are finding is that, so consultation services are not a qualifying activity either. So what we are finding that pretty much all of our clients who are in a service-based industry are not going to qualify for the free zone exemption because most of them do have the setup where they are servicing clients, outside the free zones, and it's not a qualifying activity. There are a couple of exceptions to this. So if you provide logistics services, now logistics services are things like cargo brokerage, transport agencies, things like that, which are sort of embedded in that, basically logistics services covers, I guess, services that are embedded in the other industries that are listed here. Then you may qualify for this, but it's got to be quite specific. So, like I said, something like cargo brokerage or transport agency. There is one more, which is distribution of goods in or from a designated zone, which we'll come back to in a second. So just back to the layers to fall through for a free zone business. So if you're a free zone company, right? Let's say you're selling outside the free zone, so you don't meet the first criteria. You're not doing a qualifying activity, so you don't meet the second criteria. The third thing that you look at is what's called the small business relief. Okay. The small business relief rule says that if your revenue is less than 3 million dirhams per year, then you don't have to pay any tax. Okay. This is a very friendly, nice, lenient rule to really soften the blow for smaller companies. I think it's so important to have this rule straight, from the outset, because as we've just seen, the qualifying free zone exemption is a very narrow, very specific, set of rules to meet, and not many of our clients are meeting that. However, all of our smaller clients will be under this 3 million threshold. Okay. So if your revenue is less than 3 million and you don't meet the qualifying free zone exemption rules, you still won't be paying any tax. Okay. So your revenue is under 3 million. What do you have to do? You still need to register. You still need to produce proper accounting, right? And you still need to file a tax return. Now, you have to do the accounting because you need to be able to prove that your revenue is under 3 million. And then when it comes, and the way you prove that is by submitting those accounts when you file your tax return. And you say to the tax authorities, hey, look, I've done my accounting properly. My accounting shows that my revenue is less than 3 million. Therefore, I qualify for the small business relief. And the federal tax authority will say, yep, great, thank you, no tax to pay. Okay. So this has been a really, I think the majority of our smaller micro clients will be qualifying for this because they won't be going for the free zone exemption, which is a great relief to all of them. There is one caveat around the small business relief, which we'll get to, which is that it only runs for 2024, 25, and 26. And then in 2027, we don't know what's going to happen. It might go away or it might come back or be extended. Okay, so we have just covered 3 layers to fall through before you become a taxable business. So let's go through them again. So layer 1, if you're a free zone business. Layer 1, are you just selling to free zone companies? If not, okay, is your activity a qualifying activity? No, okay. Is your revenue, so your top line revenue sales, less than 3 million dirhams? If not, okay, that means you are a taxable business. So let's say you are a marketing consultancy with 4 million or 3.5 million dirhams of revenue. Okay. What that means is that you become a taxable business, and then they put your revenue aside and they start looking at your profit. Okay. So small business relief is tested on your revenue, so your top line. But then tax is levied on your net profit. So revenue less expenses is your profit. If your profit is under 375,000 dirhams, right, then you won't be paying any tax. Basically, what the rules say is that you have a 0% tax rate on the first 375,000 dirhams, roughly $100,000 of profit. Okay. So, and then only if you're making more than that in profit will you be paying any tax. And that's 9%. So you're paying 9% on your profits over 375,000 dirhams. So using the marketing consultancy analogy, all right, so they're selling outside a free zone. They're not doing a qualifying activity. Their revenue is 4 million dirhams. Let's say their profit was 1 million dirhams out of that 4 million revenue. That means that they would get of that 1 million dirhams, the first 375,000 dirhams would be tax-free, and the remaining 625,000 dirhams will be taxed at 9%. So they'd be paying around, let's say, 60,000 dirhams in tax on that 1 million dirhams of profit. Okay, before we move on, I'll just run through some questions. Does the small business relief 3 million dirhams apply to a first corp tax year of 15 months? So what we are trying to get out of the ministry right now, our assumption is that will be prorated. So, sorry, just to explain the question, someone was asking, look, if I just open my business in August, and that means my first financial year runs from August all the way to, August this year, means my first financial year runs all the way from August this year to December next year, and it's taxable. Will that 3 million be grossed up for the additional months? Look, our expectation is yes, but it hasn't been specified. We're waiting for a reply from the ministry on this. I think they will provide some more guidance on it. Probably in the new year, I'd say. Okay, question here. Oh, same question. Sorry, from Stephanie. So Mark and Stephanie both asking a very similar question. So if you opened your business in July, that means your first financial year runs July 2023 to December 2024. Same question, will it just be 3 million for small business relief, or will they allow for the extra 6 months? I mean, they've got to allow for the extra 6 months. I'll be very, very surprised if they say, no, you've got to apply that that 3 million for the whole 18. Yeah, I'm sure they'll come out with some kind of clarification. Excuse me, sorry. Okay, just going through some other questions here. So our reporting period is from April 24 to March 2025. Do we need to include the P&L for the period June 2023 to March 2024 for tax? No. So Suresh, your first tax year will be April 2024 to March 2025. Your financial period March 2024 to March 2023 to, your period April 2023 to March 2024 is not taxable, okay? So you just have to have everything in place by the 1st of April 2024. So it sounds like you might have a UK reporting company or something, because that's the financial year that they follow. But you're one of the few lucky businesses that has an extra month or two to get ready. Question here from Akmaral. So do you mean that all free zones will be under corporate tax? Yeah, absolutely. So what this sounds like confusion here is, so for example, there are designated zones like JAFSA. They have some special rules around them around paying tax, but you still have to go through all of the compliance steps. So regardless of which free zone you're in, right, you still need to register, you still need to do your accounting, and you'll still need to file a tax return. You might not necessarily need to pay any tax because you might be filing for one of the exemptions, but you still need to go through those steps to prove that you're exempt, all right? Okay, question here from Jessica around partners versus employees. We'll cover that a little bit later. A question here, I started my business in May 2023 and I haven't had any transactions. What do I have to register for? So even if you haven't had any transactions, you haven't had any revenue, it doesn't matter if you don't have a bank account, you still need to register and you'll still need to file a tax return, because think of it this way, every company starts with corporate tax. Every company is by default a tax-paying company, and you have to prove if you're not. And the way you prove that is through your submissions, your registration and your submissions. Okay, it's not like VAT where you basically have to, the onus is on you to opt in when it's relevant. It's the opposite for corporate tax. So you have to opt in straight away. Everyone has to register and you all have to file a tax return. And that tax return is when you prove whether or not you're paying tax. Okay. Excuse me. The question here, if I have multiple businesses in the UAE with separate trade licenses and each business is having revenue less than 3 million, do I still qualify for small business? So this is a somewhat complex one. Okay, so there are some what's called the anti-abuse rules. So I'll just jump through to small business relief. So we'll talk about small business relief for a second. So what you can't do is you cannot, if you have, let's say you have a business right now which has 5 million of revenue, right? What you can't do is go and split that into two businesses and put 2.5 million, in each business just to avoid tax. So through the registration process, you have to declare who the owner of each business is, and the FTA will be assessing for common ownership across businesses. And so they will be able to very easily tell if you are spreading your activities across multiple businesses just to get under the small business relief rule. What you can do is, if there is a legitimate business reason for opening a separate company, then that's okay. So if they're doing a separate activity, separate businesses, separate clients, then you can probably justify having a separate company. Now, what the FTA can still do is actually deem that they need to be combined into a tax group. For example, if there is if there is one owner who owns more than 95% of both, then the FTA can just ignore the split and just join them together when it comes to the tax filing. Where there's a little bit different is if you have a free zone company which meets the exemption rules. So you have a qualifying free zone company, and you have a separate company which does not meet those rules. That's okay, because you can't. The FTA won't force you to join those together, because if one company qualifies and one company doesn't, they just leave that alone. They'll leave the company that qualifies alone. But if it comes to separating the business just for the small business relief, neither of those companies qualifies for the free zone exemption, it'll look quite suspicious, very clear and quite clearly suspicious to the FTA. Okay, still getting some questions around reporting year and financial year. So I'll go through these because it's good to run through plenty of examples for this. So Ahmad, free zone company, one owner, started your business on 24th of April 2023. So Ahmed, if you are in a, I'm not sure which free zone you're in. If you're in DWTC, it's a little bit different. But if you're in any other free zone, your first financial year actually runs from April to December this year. You're taxable from the 1st of January 2024. Okay. The date on your corporate tax registration certificate is basically irrelevant. So you may have registered, I can register we've registered our companies a few months ago, but our tax year doesn't start until 1st of January 2024. So you can just go ahead. Oh, there we go, Maidan. So yeah, Maidan, your default is January to December, so you're not taxable until the 1st of January. Question here from Thomas. You started your company in May 2022. What you need to do, so Thomas is a DWTC business. So the way to check this is go to your MOA, your Memorandum of Association. I think it's on page 5 or 6. There's a section that says fiscal year. So this is just for DWTC companies, by the way. Go to page 5 or 6. There's a section that says fiscal year, and it'll probably say your financial year runs from May to April each year. So what that means is you're one of the super lucky ones, right? Which you won't be taxable till the 1st of May 2024, and that's as late as possible that you can start. You may be unlucky if you check that MOA, because even if you registered in May, sometimes the MOA doesn't get generated until June. And if your MOA says that your financial years run June to May, then unfortunately you were taxable from the 1st of June. So you're already sort of halfway through your first tax year. So Thomas, go and check your Memorandum of Association. I hope for your sake it says May, which will be a good result. It means you have a few extra months. Hopefully it doesn't say June. A question here from Asma around invoicing. So do you need to change the way that you invoice customers for corporate tax? No. So obviously invoices need to be VAT compliant if you're registered for VAT. So the way that you invoice your clients is not impacted by corporate tax. So just carry on. Obviously it has to be VAT compliant invoices here in the UAE. Okay. A very good question here. So if our turnover is less than 3 million and they qualify for the small business relief, do we have to do anything, or do we just wait for the FTA to ask us? Okay, perfect question, because this is one of the big myths that is going around. You cannot just sit back and do nothing if you're under the threshold. You need to register, you need to do accounting to prove that you're under the threshold, and then you need to submit your tax return, which shows, basically shows those accounts, shows that you're under the threshold, and only then will you be granted the small business relief. If you sit back and do nothing, and the FTA, relying on the FTA to come and ask you, they don't come and ask you. The first thing they do is start applying fines. So for example, the fine for not keeping proper records is 10,000 dirhams, which then goes up to 20,000 dirhams. The fine for not filing a tax return, I think it's 5,000 dirhams. So you're looking at, between 15 to 30,000 dirhams of fines if you just sit back and do nothing. So no company can sit back and do nothing. Okay, the only ones who can, theoretically, the only business owners that can theoretically sit back are the freelancers if their revenue is less than 1 million dirhams. But even then, they need to be doing accounting because they need to know if they're going to cross 3 million, cross the 1 million. That's just freelancers. Every other company needs to go through the compliance steps. So register, do accounting, and file a tax return. Question from Bojan. Sorry, some people are raising hands. If you just put your questions in the Q&A box, so the Q&A button down the bottom will open up the box. Okay, Thomas, your MOA states 24. So Thomas, there should be a section there that says fiscal period. So go and have a look. Have a look for that. It'll just show the months. So I'm getting a few questions here about specific industries. Look, it's not something that you can just sort of know off the top of your, it's not an easy question as to whether you qualify for the free zone exemption. So you need to actually go through, you'll need to do an audit, and the auditors will help determine whether or not you qualify. There are a couple of other steps you need to go through as well. That's for the qualifying free zone exemption. So that answers a couple of questions. Okay. Question here, if your revenue is less than 3 million, but profit is more than 375. So if you think of it in terms of the layers that you need to fall through, the tests that you need to fall through that we went through earlier. So, there's the free zoning, the two free zone criteria, so the geography and the activities. Then it looks at your revenue, right, for small business relief. If your revenue is less than 3 million, the testing basically stops there. So they don't even look at your profit. So if your revenue is less than 3 million, you just get an exemption. It doesn't matter what your profit is. So you could have revenue of 2.5 million and profit of 2 million, but because your revenue is less than 3, then that means they don't look at your profit. You're not taxable. If your revenue was 3.5 million and your profit was 2 million, then you'd be taxable. It's because you've fallen through that 3 million threshold test. Okay. We've got about 15 minutes left. I just want to jump through a couple of specific examples. I wouldn't call them loopholes, but just some considerations about being taxable or not, and some of the kind of key allowances in the tax laws. So one thing I want to talk about is companies that operate a dropship model. So what I'm talking about here is, if we go back to the qualifying activities, there's a rule here, right, the third from the bottom, that is called distribution of goods or materials from a designated zone to a customer that resells such goods or materials, blah, 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 blah. So what that means is, if these rules apply to designated zones, okay? Now, a designated zone is different to a free zone. So, or rather, a designated zone is a subset of a free zone. So all designated zones are free zones, but designated zones are, think of them as normally like the port zones. So you got JAFZA, you got the Ras Al Khaimah Free Trade Zone, not the RAKEZ Free Zone. Dubai Airport Free Zone, for example, they're generally fenced off, port zones that goods aren't considered as entering the UAE until they leave that zone. So the rules that we're about to talk about are for designated zones, not free zones. Okay. So one thing that they have specified in the laws is for designated zone companies, if you operate a dropship model, okay, so if you sell online, you purchase the goods from, you have a supplier in country A and the customer in country B, and the goods never touch the UAE, that activity will be exempt from corporate tax if you are a designated zone company. So if you're registered, for example, in JAFZA. So this is what we see a lot of our clients doing right now. They run an online business. The company's based in a free zone. They are shipping goods from, let's say, China to Turkey, right? They won't be exempt if they are registered, if their business is in a free zone, but they will be exempt if it's in a designated free zone. Okay, so there's a real benefit for these companies actually being registered in a designated zone. The only one rule just to consider around this is that the customer needs to be B2B, not B2C. So you need to be, if you're shipping from, supplier in China, client in Turkey, that client in Turkey needs to be an on-seller, so either a retailer or a distributor. It can't be selling to an end customer. So this is just, I'm just pulling out this specific example because we have seen a lot of clients that this relates to, a lot of, online businesses or e-commerce businesses are seeing a benefit in being registered in a designated zone instead of a standard free zone. Question here, does small business relief apply for, sorry, I'll just jump back to some questions as we go. Question here, does small business relief apply for free zone companies as well? Yes, it does. There was a bit of confusion because there was a line in the small business relief rules that said that qualifying free zone companies do not get it, which is a bit of a moot point because what all that says is if you've got the free zone exemption, then you can't also get the small business relief, but you're already exempt. So basically it is companies that don't meet the free zone tax exemption. If they're a free zone company and they don't meet that exemption, they can still go for small business relief. Question from Mark, just to be clear, if my revenues are 2.75 million, yep, and your profit is 1 million, yep, your free zone company is exempt from paying corporate tax. You still need to go through registration accounting because you need to prove that that's your revenue, and you still need to file the tax return to apply for the small business relief. But yeah, if your revenue is less than 3 million, it doesn't matter what your profit is. It's going to be exempt from paying corporate tax. But just a reminder, that rule is only in place for 2024, 2025, and 2026. Which leads us to our next little question. So, small business relief, right? Let's take the scenario of a company that benefits from small business relief. So they're under 3 million in 2024, 2025, and 2026. 2027, that company becomes a taxable business, right? So This also applies for any company that has got more than 3 million dirhams of of revenue right now. Okay, so any taxable business, the tax is levied on the profit, not the revenue. So just the same as the rest of the world, we need to start thinking about, if you are a taxable business, how do you legally push down your profit to minimize your tax bill? The biggest question around this, or the biggest point around this, is around owners paying themselves a salary. Okay. Now, what we don't have yet, we don't have any specific guidance from the ministry around owners paying themselves a salary. What we do have are some general rules around what's called payments to or transactions with a connected person. A connected person is deemed to be a shareholder or a director, as well as all the way down to, I think it's the 4th or 5th level of kinship, which means either a shareholder or a director, or their spouse or their child or their grandchild or their niece or their great grand niece or nephew. So it goes pretty far down the family tree. Any transactions with any of those people or with companies that those people own is deemed to be a connected person transaction. So when we come back to, can an owner just pay themselves a big salary to minimize the profit? That is a connected person transaction. Now, the rules around connected person transactions is that those transactions have to be at market value or arm's length. So the way of thinking about it is, all right, if that business owner left their own business and went and worked for an unrelated company, right? So went out on the street, got a job for an unrelated business, what would that person earn for the same role? Okay, and that is sort of the benchmark for the owners paying themselves a salary from their own business. So one of the things we get quite often is, for example, a consultancy business, right? Management consultancy. Let's say it's a management consultancy, they're earning 4 million dirhams of revenue, so they don't get small business relief. Okay, and so 1 or 2 person company, how much salary can those shareholders pull out for themselves? Okay, in those cases, we'd have to look at, all right, well, what does a partner in I'm just using this as an example, but what does a partner in a consulting firm earn per year, right? And you could quite easily get that number up to 1.5, 2 million dirhams, okay? So that is the sort of benchmark that you need to look at. Now, there is an exercise you can go through and actually get external data, do a benchmarking exercise, which we've been doing for a few clients already. But again, you only need to worry about this right now if your revenue is more than 3 million dirhams. If your revenue is less than 3 million dirhams, then you can pay yourself whatever you want because your profit's not taxable. So what we've just covered there is around the amount that a owner can pay themselves as a salary. But there's actually 2 parts to owners paying themselves a salary. Okay, now, again, we don't have the specific rules around this yet, but what I'll explain is what we see in Saudi Arabia. Okay, so the approach that we have or the rules that we have in Saudi Arabia, for someone to pay themselves a salary, there are 2 things that need to be considered. Okay, the first step is the compliance step. Okay, so it is what does a person have to have in place so they are able to pay themselves a salary out of a business? Okay, so that is obviously a visa, an employment visa, an employee visa in Saudi. They need an employment contract with the company. That contract, needs to be lodged with the Ministry of Labor, which also specifies the salary amount. Okay, so we have the same setup here in the UAE, but what we don't know is, do companies or does a person have to have that set up for a salary to be deductible in the UAE? The way that it works in Saudi, you have to have all of those things, and basically the amount of salary that you can claim as deductible, the amount that's on the contract, on the employment contract, is deductible basically with no questions asked. Anything above that needs to be proven from if it's a bonus, you need to show how it was calculated. If it's other incentives, you need to basically justify any amounts over the contract amount. I don't know if we're going to go down the same level of detail here in the UAE. I'm hoping not, right? But what that would mean is if we did end up going down that road, what that would mean is that owners of a company, instead of being on an investor visa, they would need to switch over to a employee visa. So that company would need to open a labor file. You need to be an employee of your own company. You'd have to have a employment contract, registered employment contract. And then, the amount that you pay yourself would still be benchmarked, but you'd basically say, look, you've got a contract amount, and then over and above that amount is, benchmarked against external data. So not an easy answer to that, and you certainly can't just pay yourself a huge salary, to just wipe out all your profit. There's a question here: what about my personal home registered under the company's name? So this is called various things around the world. New Zealand, we call it fringe benefits, or people call it benefits in kind. So let's say that you are paying yourself a salary from your company, but your company is also paying the rent on your villa that you live, your personal villa. They're paying for your personal car. All of that kind of stuff gets loaded up as a dirham, an actual currency value, and that gets added to the amount. So they will look at the total remuneration package. So you might pay yourself a salary of 1 million dirhams, and then you've got about 200 or 500,000 dirhams worth of benefits on top. Then the amount that you are deemed to have paid yourself is 1.5 million dirhams, and that's the amount they will look at to see if it's reasonable or not. Okay, some more very specific questions coming in here around reporting period. What I'll do, I've just got a couple of minutes, so I just want to quickly cover offshore zones, because I know there are a few clients coming through that actually have companies or entities registered in RAC ICC. Before we move on to that, so everything we've just covered today, you can try and remember, or you can just go to taxready.ae. We're doing all of this for free right now, so you can jump on there. We'll do your registration. We get your accounting all up and running, onboarded on accounting software. We do 3 months of accounting for free. We give a 0 penalty compliance guarantee as well. So you can just go there, sign up, we'll walk you through it all. And obviously, we do free consultations as well. So if you have these specific questions around your own business, what you need to do. So absolutely, you have to register and you have to do accounting anyway. So go ahead and do that for free with us. And we also do free consultations where we can cover, the specifics around your own business, around the reporting deadlines and everything like that. And also cover whether or not we expect you'll be paying tax. Okay, so look, that's if you have a offshore company or offshore entity, so RAC ICC or anything, feel free to stay on. I know it's only relevant to a few people. If it's not relevant for you, you can feel free to leave. We've covered everything for the free zones and the mainland companies. But yeah, if you haven't done anything yet, just please remember you have to have your accounting up and running by the 1st of January. The fines for not having your accounting up and running is, pretty significant. So it's 10,000 dirhams or 20,000 if you can't rectify it. So, really encourage you, jump on Tax Ready. You can go through there. You can also register for a free consultation call as well via that as well. So go for it. Okay. And thank you to those of you who joined who are now going to leave before we go into offshore zones. All right, offshore zones. So if you have an entity registered in RAC ICC or one of the other offshore zones, this is one of the other areas that we don't yet have. Actually, I'll stop sharing my screen for a second. So offshore zones are one of the things that we don't have direct guidance from the tax laws yet. So offshore zones, because we don't have direct guidance, we have to look at what the other rules say and how those can apply to offshore zones. So Right now, the tax law basically treats a offshore zone the same as any other company that's not registered in the UAE. So the same as any kind of offshore company. And so what the test there is, it looks at, okay, there's basically two things to look at. One is that, we'll use RAC ICC as the example. So one is that RAC ICC company controlled from within the UAE? So is the effective place of management within the UAE? So if you have a RAC ICC company, right, and that owns, shares or whatever, but you live in the UAE, you manage that RAC ICC company from within the UAE, that means that the RAC ICC company will be deemed to be tax resident inside the UAE. So corporate tax applies to that RAC ICC company. The other test that it looks at is, does that RAC ICC company own property within the UAE? So immovable property, so real estate. If that's the case, then again, it's deemed to be resident within the UAE for tax purposes, and the corporate tax will apply. Won't necessarily pay tax. In fact, it's unlikely that it will pay tax, but it still has to go through those compliance steps. Okay, so it still needs to register, still needs to file a tax return and do the accounting and everything. Right now, the FTA isn't really accepting registrations for offshore companies or RAC ICC companies unless you have a tax residency certificate. Now that's a whole different process, and it's only really clients that want to show that the RAC ICC company is resident in the UAE that are going through the process of obtaining what's called this tax residency certificate. So a couple of other things about offshore companies. So again, RAC ICC. I'll use the example of a RAC ICC company which just exists to own the shares or owns a UAE company. Okay, so RAC ICC, so let's say person lives in the UAE, they have a trading company here in the UAE. All right, so in a free zone or on the mainland. That company is, that company is actually owned by the RAC ICC company, right, which is in turn owned by that UAE resident. So UAE resident owns a RAC ICC company, offshore company, which owns a UAE trading company. So the UAE trading company will be subject to corporate tax, may or may not pay corporate tax, right, depending on what the activities are or anything, which we've just been through. If that company pays a dividend to the and because the RAC ICC company, because it is controlled by a UAE resident, that is deemed to be resident within the UAE as well. Okay. If the UAE company can pay a dividend to the RAC ICC company, which can pay a dividend to the UAE tax resident owner, and that dividend is not taxable at all, because the RAC ICC company, even though it's deemed to be within corporate tax in the UAE, dividends from UAE companies are exempt income, and so that can just be passed through with no tax leakage at all. So that's actually all fine. That's the reason I've gone through that example. It's probably the most common example I have, where UAE-based person, they've put ownership of their company in an offshore, in a RAC ICC company, and they're asking around, well, can I pass the income, the dividend income, all the way through? The answer is yes, it won't be taxable. But when it comes back to the basic side of it, does a RAC ICC company need to register? Again, we don't have specific guidance just yet. We're just waiting either for specific guidance, or if we don't, then we'll go through the process of determining tax residency. But until that tax residency has been determined, you can't really do anything. So as of yet, you can either go ahead and try get a tax residency certificate for your RAC ICC company, which will allow you to register or prove that you can register, or you can sort of hold fire until I guess the new year to work out whether you need to register or not. Again, the only thing I would make sure that you do have in place if you have a RAC ICC company is you still need to make sure you get your accounting up and running for the 1st of January. Okay, sorry, we've just run over a little bit. Hopefully that was somewhat clear on the offshore companies. If you're still unsure, please just send through a, jump on Tax Ready and we can contact you that way, or send me a message directly and we can set up a call. Okay, thanks everyone. Sorry we ran over a little bit. There were quite a few good questions in there, but we will end it there. And again, go to taxready.ae if you want to get on board for free and get everything up to speed for free. And hopefully we'll talk again soon.